Hello, this is Gary Sherman of Whaddadunce.com. Today we're going to conclude our series on how the financial markets price risk, and we're going to be talking about the capital asset pricing model, or the CAPM. In this slide, we're going to take a look at historical market returns. What we've done is we've gone into the software under the time series tab and charted the S&P 500 composite return with the 10-year treasury rate, and then took the difference. If we look at the table there, the S&P 500 composite, the annual return mean has been about 9.53%. So if you invested in the S&P 500 over the long term, that is the return you've gotten, but the return volatility is about 18%. And basically what this means is that in any given year, I would expect to have an annual return of 9.53%, but 66% of the time, or approximately two-thirds of the time, my actual return would be 9.53% plus or minus that 18% volatility. And then we looked at the 10-year treasury rate, and the average return mean was about 5.51%. The current treasury rate is about 4.7%, so it's a little below that average return mean. And then we took the difference between the S&P 500 composite total return and the 10-year treasury rate and charted that. And what we've come up with is that the difference between the 10-year treasury and the composite is about 4.9%, 4.97%, or approximately 5%. And this is the premium that investors demand for investing in the S&P 500 versus the 10-year. And what we found with utility models is we define risk as volatility, and you can see that the volatility of the S&P 500 is much greater than the volatility of the 10-year. So therefore, the 10-year rate is a lot less than the annual return on the S&P 500. On this slide, we're going to take a initial pass at calculating the discount rate. Now, the discount rate, remember, is the rate that we apply to discounting future cash flow. But remember that if I discount my future cash flow, which is going to be volatile, at 10%, then that's the return I expect into the future. So what we've learned from the utility models is that we define risk as the standard deviation of returns, or volatility. So we're going to take a look at this example. We're going to say that we have an individual stock with a volatility of 40%, and then we have the market, the S&P 500 composite from the previous slide, with a volatility of around 18.42%. And then today the risk-free rate on the 10-year treasury, or the 10-year treasury rate, is 4.75%, and then the equity risk premium from the previous slide is 4.97%. So just by looking at this, you would say, well, geez, if I'm going to invest in the S&P 500 composite, I'm going to get 9.53%, but my volatility is going to be 18. Now, if I invest in an individual stock at 40% volatility, then initially I would expect a much, much larger return, because I'm taking more risk. And remember, the more risk that you take, the bigger the discount rate. So we can look at our definitions. Remember, we defined risk as a return volatility. That's the standard deviation of returns. And remember that returns on the S&P 500 are thought to be normally distributed. And then we're going to define this thing called beta. And we're going to define that as the ratio of the individual stock return to the market return. And these are volatilities. So if we looked at the beta for this stock, we would basically say, well, what's my return, or what's my return volatility on my individual stock? And that's 40%. And the return on the market, the market volatility, is 18. So therefore, my beta ratio would be that 40% divided by the 18.42%. So we can look at equation E1, and this is our initial pass at calculating the discount rate. And remember that our stock volatility is 40%, so it's much riskier than the market portfolio of 18.42%. So our initial pass at calculating a discount rate would be, well, what we're going to do is we're going to say, well, our discount rate is a risk-free rate. That's where we start. And then we want to calculate what we want to earn over and above that risk-free rate in order for us to invest in this individual stock. So what we would do is we say, well, geez, we have a risk-free rate, and then we want to take the beta which is the ratio of the individual stock volatility to the market volatility. And we're going to take that ratio and then we're going to times it by the equity risk premium. The logic here is that if the market return volatility is 18% and my individual stock return volatility is 40%, then my equity risk premium, or the premium over and above the 10-year, would be 40% divided by the 18% times that equity risk premium, and that's exactly what we've done. So take a look at equation E1 again. Our risk-free rate is 4.75%. Our beta is, remember, that's the ratio of the individual stock return volatility to my market return volatility. That's my 40% divided by 18.42%. And then we times that by the equity risk premium. So our initial pass at getting the discount rate is 15.54%. Now, this initial pass isn't the way that it's kind of the way that the market prices risk, but we have to make some adjustments due to diversification, which we will explain later. On this slide, we want to take a look at modeling random stock price. Now, this slide is primarily for the math geeks out there. So if you aren't a math geek like me, you might just want to, just follow along, but don't take a lot of this to heart. So if we have two stocks, we have stock V and stock W, and both of those stocks start at $20. Per share. And what we want to do is, if we had an Excel spreadsheet in front of us, we want to model, how these stocks are going to perform over time. Well, we know the stock price today, but we don't know the stock price tomorrow. We don't know it a year from now, 10 years from now, etc. So these are pretty much the equations that you would use in your Excel spreadsheet in order to model stock price. And and remember that you're not supposed to remember all this stuff, but it helps to explain, especially when we get into diversification, how this all works and how the CAPM works. So equation E1, stock prices are normally, or the returns on stocks, total return is normally distributed. So what we want to do is we want to pull three normally distributed random variables out of thin air. So what we're doing here is Z subscript M, and then we have Z subscript V, and then Z subscript W. We're going to pull these random variables out of a normal distribution. And then we're going to go to E2 and E3, and this is how the returns would be modeled. Remember that these are random returns, so it would depend on those random variables that we pulled in equation E1. And note that in E2 and E3, we have Z subscript M in both the equation E2 and E3. This is how we model correlation. If we have two stocks that were completely uncorrelated, then the correlation coefficient for that would be 0. So therefore the ZMs would disappear. But as the correlation goes from 0 to up to 1, that first random variable E subscript M, which is common to both equations, comes into play. And then E4, that's basically describes the variables that we use in E2 and E3. And in E5, that is our stock price at the end of time t. So in other words, we start at time 0. We want to have a stock price at the end of, let's say, end of year 5. What we would do is we would go to E2 and E3, calculate those random returns. Then the E5, that equation says that my stock price at the end of year 5, or at the end of year t, is the beginning stock price times the exponential of those random returns. So again, this slide is for the math geeks out there and the Excel warriors. So if that's not you, just take a look at it and note. And the important thing is that in equation E2 and E3 is that we are using the same random variable, that Z subscript M, in both equations, and that's how we model correlation between returns, stock price returns. In this slide, we're going to take a look at diversification. And in this case, we're going to assume that stock prices are correlated. So remember from the previous slide, we had stock V and stock W. And we're going to assume that those stock V and stock W are basically the same. But the only thing that's going to differ is the correlation coefficient. And in most cases, correlation will go from 0 to +1. So we have stock V and stock W. The beginning stock price is $20 for both. My expected return is 9.5% for both. And my return volatility is 40% for both. And the question is what if I combine both stock V and stock W into a portfolio? So I would take a certain weight, let's say it's 50-50. So I would take 50% of my stock V and 50% of my stock W and combine those into a portfolio. Now, in this case, we're going to assume that the correlation coefficient is 0.95. So these are very correlated. And the question you have to ask yourself is I want to be diversified. So what would it look like as far as from a risk profile if I took a certain weight of stock V and a certain weight of stock W and combined them into one portfolio? What I want to happen is if I have losses on stock V, I want to have gains on stock W so that they offset. And the same thing with gains. If I have a gain on stock V, I want to have a loss on stock W so that those basically the gains and the losses offset. So therefore, the volatility of my portfolio, even though the individual volatilities are 40%, my volatility on my portfolio return will be much less because those gains and losses will offset each other. But notice that when stock prices are correlated, and one is the maximum correlation. So here we're using 0.95. So these are very correlated. So what I've done is I've taken those equations from the previous slide, popped them into an Excel spreadsheet, and did a modeling run. I pulled a bunch of random variables out of a normal distribution, and the chart on the right-hand side is what I've gotten. So on the vertical axis, we have price, and then on the horizontal axis, we have year. So this is what my, at least for this one run, this is how my stock price would look. And because they're very correlated, these stocks, V and W, run in tandem. They're very, very close. There's a small difference, but because they're so correlated, the path of stock V is going to be pretty much identical to the path of stock W. So I don't get any diversification benefit. If I looked at my portfolio return volatility, it's going to be close to 40% because I can't get any diversification benefits because these stock prices are so correlated. So now what we want to do is we want to take a look at what a portfolio would look like if stock prices are not correlated. So the table on the left-hand side, this is pretty much the table from the previous slide. The only difference is we changed our return correlation from 0.95 to 0. So these stock returns are not correlated, and so therefore stock V and stock W would be ideal for a portfolio. And remember, what we want to happen is that when we have losses on stock V, we want to have gains on stock W. And when we have gains in stock V, we want to have losses on stock W so that the gains and losses they offset each other. And that's exactly what we have if you take a look at the graph on the right. The blue line is stock V, the orange line is stock W. So when stock V has gains, stock W has losses. And then we find that as we go through time, the situation reverses. Now we have gains on stock W and losses on stock V. And that's exactly what we want. We want the gains to offset the losses such that the portfolio is much less volatile than the volatility of the individual stocks. And that's exactly what we have here. So if we had a portfolio, what we want to have is in order to reduce our volatility, remember that risk is defined as volatility. In order to reduce the volatility on the portfolio, what we want to have is we want to have stocks that are not correlated. We want to have the correlation coefficient get to close to a 0 and maybe even negative in order for that to happen. In the previous slide, we talked about modeling random stock price. In this slide, we want to talk about modeling random portfolio price. And again, this slide is primarily for the math geeks and the Excel warriors out there. But if that's not you, then please just follow along because we're going to come to some very important conclusions. So E1, so in other words, what I want to do is I want to take a certain percentage of stock V or a certain number of shares of stock V and combine those with a certain amount of shares from stock W. So in other words, if I want to create a $100,000 portfolio and my weights were 50%, I would take 50% of that portfolio or 50,000, take that and buy shares of stock V, and then I would take the remaining 50,000 and I would buy shares of stock W and combine those in a portfolio. So equation E1 are my portfolio weights. So therefore, my portfolio at time zero would be equation E2, and that's just taking the weightings of the original stock price. And then my portfolio mean. Now this is very important. That's equation E3. My return mean would just be the weightings, my weightings of what I expect to return on stock V and stock W. So basically what this says is if I expect a return of X on stock V, and I expect that same return, which is the case with the example on stock W, and I combine them, my return on the portfolio would be exactly the same, or my expected return would be exactly the same as if I invested in stock V alone and stock W alone. So the return mean is just the weighting of the stock, my expected returns in the stock. But when diversification comes into play with the portfolio return variance. Now, E4 defines the return variance. Notice the last part of that equation where I have those row subscript MV, then row subscript MW. Those are my correlation coefficients. And what I want to do is, in order to reduce the return variance, what I want to do is have those correlation coefficients, the product of those two, as close to zero as possible. So if the correlation coefficients were 1 for both, then my return variance would be a lot higher than those correlation coefficients if they were 0. So if the point here is if the correlation coefficients are not 1, then portfolio volatility can be reduced by diversification, and that's what we want. So therefore, what we want to do is we want to combine the stocks V and W, which have individually high return volatility. We want to combine them so that the correlations between those two are less than 1, such that my portfolio return variance is a lot less than the variance or the volatility of the individual stocks. On this slide, we're going to take a look at portfolio return volatility and how correlation affects return volatility. So the table on the left-hand side, these are my stock V and stock W. Basically, nothing has changed. What we're going to do is we're going to take 50% of my portfolio is going to be dedicated to stock V, and 50% of my portfolio is going to be dedicated to stock W. And the question is once I combine those two stocks into a portfolio, what does my portfolio return volatility look like? And remember, what we want to do is we want to have a portfolio where the return on the portfolio is the same as if I would have invested in stock V and stock W alone, but the volatility is much less. So what we have is, if you take a look at the graph on the right-hand side, the vertical axis, that's my portfolio return volatility. And then on the horizontal axis, these are my correlation coefficients. So you can see that if my correlation coefficients for both stocks is 1, I get 0 benefit from investing in stock V alone or stock W alone or combining those in a portfolio. But notice that as my correlation coefficient goes from 1 and down to 0, the return on my portfolio as far as volatility gets much and much less. And this is exactly what we want. We want to combine stocks that are uncorrelated such that I get the same return as if I invested in V or W, but if I combine them in a portfolio, my volatility is much, much less. So in this final slide, what we want to do is we want to take our initial pass at the discount rate and we want to account for correlation. And this is basically what the CAPM does. So if you look at the table on the left-hand side, this is our example from the previous slide. We have individual stock volatility of 40%, market volatility of around 18%, and then we have the risk-free rate, which is a 10-year treasury, about 4.75, and the equity risk premium about 4.97. But what we want to do here is we want to assume that the correlation of the individual returns with market returns is 0.75. So we do get some diversification benefit. So again, the definitions are the risk is the same. It's return volatility, and we've basically concluded from our look at utility models that risk is defined as return volatility, and my beta coefficient now is different. Originally, from the original slide, what we did is we said, well, geez, my beta should be the individual stock volatility divided by the market volatility, but that's not the case with the CAPM. With the CAPM, it assumes diversification. So in other words, what the discount rate says is that if I want to hold an individual stock, that's fine. I can take the risk, but I'm not going to be paid for it because the CAPM assumes that everything is in a portfolio environment. So therefore, the portfolio volatility is reduced because of diversification. So therefore, you're not going to get compensated if you choose not to diversify. So my beta now is the ratio of my individual stock return volatility to market volatility, which is the same as in the previous slide. But now I take that ratio and I multiply it by the square of my correlation. So if I look at E1, this was the discount rate that I calculated from my first pass. I basically said it's my risk-free rate plus my beta times my equity risk premium, which was 4.75%. That was my risk-free rate. And then my beta was my individual stock return volatility of 40% divided by my market return volatility of 18% approximately, multiplied by the equity risk premium of 4.97. So I got this discount rate of 15.54%. But the CAPM basically says is that the market is not going to pay you 15.54% because the market is only going to compensate you for it. Basically, what that says is I can diversify away all my specific risk, such that the only risk I have left is my market risk, and that's what the CAPM does. It assumes that you're diversifying away as much as you can, and what you're left with is the stuff that you can't diversify. So you're going to get compensated for that. But if I choose not to diversify, then I don't get compensated for that added risk that I take. So therefore, E1 becomes E2. So my final pass at my risk-free rate or my discount rate is basically the same as equation E1, but I take into account correlation. So I take E1 and notice that the difference is I multiply my beta value times my correlation squared. So therefore, my initial pass at discount rate was 15.54%, which assumes that I'm not diversified. But the CAPM only compensates you for the stuff or the risks that you can't diversify. So in other words, if I can diversify some of my risk, I'm not going to get compensated for that. But the stuff that I can't diversify away, I'm going to get compensated for that. So therefore, in E2, which is my final pass at my discount rate, I multiply that beta coefficient by my correlation squared. So therefore, I get a discount rate of 10.82%, and that's what the CAPM gives you. So come join our community at Whaddadunce.com. It should be fun.